Well, hello, Maverick traders. Welcome out to your Diagonal Spreads Trading Lab. And I really enjoy these trading labs. They are a lot of fun where we can go and search and look for opportunities and talk about different things that we would look for within a trade, what type of characteristics we would want to see, and so on. So let's do that today. We're going to start by just taking a little bit of a technical look. So you could start by looking at the S&P 500 and kind of get a broader market perspective. Certainly in terms of the markets, the trend has been up. I'm a little concerned that today is an exhaustion day, and I won't go through all of that. You can kind of see it. If we look at SPY, you can see that there's an increase in volume today. That maybe shows up a little bit more than in SPX, but part of what I'm kind of looking at is called a bear trap. See how the high, whoops, I didn't put the S there. Let's try that again. See how the high yesterday, we gapped down? That's called a bull trap, and the reason it's a bull trap is basically anyone that bought late in the day yesterday immediately woke up today with a loss on their hands, right? And so now they're trapped in a losing position. That's how highs can kind of form, and especially given that we're going to have an increase in volume yesterday. Notice how the volume was light, and then a big volume spike on a day where the candlestick was super large in comparison to all of these other candles. So the reason I say it's an exhaustion is when you see the biggest size candle in many days, you see the biggest volume spike in many days, you get a gap away from it, leaving these bulls trapped in a losing position. And it happens at the end of an extended move where we had literally gone up almost every day for the last month in a row. That is a sign of exhaustion, at least temporary, if not something more. And usually a bull trap like that will have some follow through. So do I think it's the end of the world? No. Do I think it's the end of this move temporarily and that we're going to test some lower prices and kind of fall in for a while? Yeah, I do. I think this is kind of a bad market setup. Now, contrast that and compare that to other areas. So we could go and say, well, let's find a diagonal put spread. That would be reasonable. Where if we think the market's going to be a little soft for a couple of weeks, that would fit that. Or you could think about alternatives. You could say, well, what moves to the beat of its own drum? What moves differently than S&P? How about gold? Gold is an alternative asset class, right? It doesn't really move in lockstep with the market. A lot of what's good for gold is bad for stocks, vice versa. It's really just a shiny metal, so I'm certainly not ultimately a gold bug. But let me show you a long-term chart of gold. So if we go back, let's go back 12 years or something. Look at how much the S&P has advanced. Look at how far stocks have gone since specifically 2011. And look at how, stocks have gone up. They're, triple, quadruple in price. Look at what gold has done. It has been absolutely horrendous. I mean, terrible. We're still below the 2011 peak. And so gold tells a completely different story. But that's part of what makes gold interesting is it's, again, an alternative play versus the market. Now, this is a really long-term chart. So if you are going to play gold based on a really long-term chart, you're probably going to have a little longer-term setup. I'm going to trade a multi-month setup today in gold and show you a diagonal based on a multi-monther. But we're not going to trade this as like a 2-week or 3-week option. First, I want to talk about the setup itself. Whoops. Get that to extend over. What do you see here? Well, we know that gold peaked out in 2011, basically at 186 in GLD. GLD just tracks gold, perfectly, essentially. From 2011, we fell on hard times. And look at how clean this cup pattern is. I mean, picturesque. We plummeted all the way down there. and made our low at the end of 2015 at 100. So gold from 186 to 100 lost on a percentage basis. If we think about it that way, it lost 86 points from 186. That's a drop of 46%. 46% of its value was lost from peak to trough. And then it staged a recovery over the last few years, and it climbed all the way back. Markets do this. It temporarily broke through what we would call a false breakout. Usually when you go back to a critical area like that, there can be a little weirdness to it. The market has kind of a perverse sense of humor where it rammed through there just to hit stop losses and suck people in, and then the normal trade, it backed off. Well, if the cup is this size, what should a handle look like? Well, the handle should be about 30% of the size of the cup. So if we say the cup is from 186 to 100, okay, that's an 86 point cup. The handle should be about 30% the size of that. So what's 30% of 86? Well, 86 times 0.3, it's 25.8. Call it 26 points. So when we back off of 186, it measures about 26 points lower. In other words, a 30% pullback to form the handle here should take us down to about 160. Well, it went to 157. Close enough. That's basically, you can see that this handle is in the neighborhood. It's not an exact science, but it's in the neighborhood of about a 30% size as compared to this big cup. And that's how a cup and handle will look. If this handle goes down 50%, well, it's not a cup and handle. It should be in the neighborhood of about 30% the size of this cup pattern. And it is. I mean, it's pretty picturesque. Look at what happened last week. Gold has been falling the past couple of weeks, and it came down and it hit 160 and made a higher low than the prior low at 157. And now we're trading at 166, 167. So it's already up 7 points off the low. But notice it set, this is important, it set a higher low. It's already showing signs of strength here in the short term. And maybe what I like about gold the most is how hated it is. You know, it's lost out to crypto. Crypto's outperformed it. It's lost out to stocks. They used to, if you go back to 2011, they would have the gold bugs, the big cheerleaders for gold like Peter Schiff. Well, he was on television every day touting gold and how it's going to 5,000 an ounce and 10,000 an ounce and so on. And that's kind of how markets work. At its euphoria, it of course is a better selling point. It's, you know, long term, euphoria is not where you want to rush in to buy. You want to rush in to buy when everybody essentially is given up and hates it, and yet it's starting to show signs of strength. So my thesis is that gold should do what? Well, if this is a handle, it should work its way back up to 185. And the next time in a cup and handle, the third time up to this resistance, you don't go through the first time, that's the finishing of the cup, you back off 30%, and then when you get there the third time, it's up and away. So my thesis is that gold is a buy here. It works in a bad market environment. It works based off of the technical setup. Now, is it guaranteed to succeed? No, nothing is. But I like the setup, and I like it to kind of, you know, work its way, grind its way higher. So now we've got to think through the process here. You know, what's realistic? How long will it take to get to 185? Are we playing it all the way up to 215 or something? You know, if you're playing it for the massive move on a longer term scale, you might be buying a leaps option. You might be buying something that is 15 months or 18 months out there, 2 years out there, if you really wanted to play that entire trend. We're going to build a trade that's just a few months, kind of say, okay, well, it can get to 185 by the end of this year, that sort of idea. So let's build a diagonal, and a diagonal works well if there's kind of the back and forth. If I thought this was just a runaway move, well, maybe I'd be more aggressive. I'd buy a call or, something more aggressive. If it's going to just kind of work its way higher, that's where a diagonal should kind of shine and do its best work. So if we pull up the options here for GLD, first of all, we got to decide, kind of longer term, shorter term, and all those sorts of things. I'm just going to go to the end of the year. Now, GLD has what are called quarterly options. You could trade all the way to the end of the fourth quarter, December 31st, but those won't have quite as much liquidity as a monthly option. You'll notice the bid-ask spreads are tight here. That's great. That means it's easy to get executions at good prices. And with GLD trading at 167 or what have you, we're probably buying a delta that's a little in the money. So as I'm looking at the delta column here, I'm probably buying something that's going to cost a bit of money, but it gives me a pretty good bang for my buck. As GLD climbs a buck higher, this makes 65 cents or something to that effect. So I think this 162 call is pretty reasonable at a 65 delta. It's going to cost us how much money? About $8.45 if we split the bid ask. Well, it just ticked up. Call it $8.50. Okay, we're going to pay about $8.50 for that option. And we're going to own the 162 calls all the way from today through December. And so that's our underlying, right? Let's write this down. We're going to buy the December 162 call, and it's going to cost us about $8.50 for that option. Now we've got to decide what to sell. And as I go in to sell, our longer term target is this thing can go to 185. Remember, that's the top of that cup. I'm going to go to a 1 month option away from here. And I'm going to do something a little different. So ignore these circles. I'm going to take the at the money straddle. Because in at the money straddle, you can build your own probability graph. You can say, okay, let's do it in a different color so we don't get confused. I'm going to take the at the money strike. I'm going to add the value of the put plus the call, and that's going to give me my probability range. Well, 270 plus 280. Well, let's just call it 280. Let's just, it doesn't have to be exact. 280 plus 270 gives us 550. I want it to be a simple number. So the at the money straddle, 1 month away, is going for $5.50. What does that tell me? That tells me that I can basically build my graph to say, okay, the stock is at 167. If I take the at the money straddle, I can add it to and subtract it from current prices, and it gives me my 68% probability range. This is where the stock should land. So between, call it 172.50, if there's a bullish move between now and September expiration, 172.50, that's current, at the money level plus 550, or 167 minus 550, bottom side is 150, and that's your range. There's a 68% probability that you'll be between 172.50 and 161.50. Why is that helpful? Because now I know where it's likely to be. This is, statistically speaking, one standard deviation, and I know where the bullish target is. I didn't really have much to work off on the chart because my longer term target is 185, but I can't get any premium selling a 185 call. I need to sell a short term call, and I'm playing this to 185 over time. I want to know what call can I sell that even if we get a bullish move, it's probably going to finish at that strike price or a little lower, which means my underlying call gained value and the call that I sold still expires worthless, and I still make my money from it. So you can see up here, if we sell a strike price that is close to that target 172.50, it's going to pay us $1. $100 to sell that option. So that's the second part of this. We can go back to our other color and keep building this trade. We are going to sell the 172 calls, and that's going to pay us $1 in premium, making our net debit how much money? $750. So you have $750 of risk in this trade. Now, when we think about this trade in terms of risk and reward and probability and so on, what's our risk graph going to look like? Well, it's going to basically have a risk graph that is going to go up and then peak. Its tippy top peak is going to be right at 172. And we can even take our deltas and figure out our delta differential, kind of how much this trade is going to make as the stock is progressing. And let me kind of explain that. The call we bought had 65 delta. The call we're selling has negative 24 delta. Why is it a negative? Because we're short that call. We're selling it. So what's our net delta in this position? Well, we have 41 positive net delta. So that kind of gives you a sense of this trade that you have on acts very much like if you owned 41 shares of stock. If the stock goes up $1, you're going to be up $41. Stock goes down $1, you're going to be down $41. That is your net delta. You're making 41 cents on the dollar. Per $1 move in the stock is going to change this spread's value. That 750 value is going to go up or down by 41 cents. If GLD goes up $1, this 750 that we paid will now be worth 791 roughly. If the stock goes down $1, guess what? We paid 750 for it, but it's now worth $7.09. It will go down by about that delta. So that gives us a sense of kind of where we're at in terms of this risk graph. Let's just rewrite it here. Okay, 750 debit is what we paid. 41 delta. And we have the 162, 172 diagonal call spread. We own December. We're short September, right? And that's our trade. Now, if you look at this risk graph and we kind of examine how this trade is going to progress, right now the stock is around 167 per share. So maybe we'll label it down here. We'll go 167, 168, 169, and so on. And I just kind of want to show this side of the risk graph and show you what it looks like and show you that you can draw these by hand. You can essentially figure out, and it's a good practice, it's a good way to learn. If we just throw the stock price numbers on here, and then I just created kind of profit up here, losses down here, you know, break evens and such. So where are we at in this trade? Well, basically the stock's trading around 167. We're going to make 41 cents for every $1 increase, and we're short the 172. So our peak gain is going to be if the stock's at 172. And if we kind of make a guesstimate, that's 5 points higher, times our delta of 41, it kind of puts us in the range of we'll be up about $205 if the stock is at 172 at expiration. So we'll look just over here at 200. We'll mark it above 172, and that's kind of our peak profit. And then, you know, if we're around current prices, we'll probably be up a little bit, quite honestly, because this will erode at a faster pace than this. This has more theta. But let's just kind of assume that we're still around break even. Our risk graph would kind of look like this, where it would climb up more and more and more as you go to 172. And then even if you overshoot the mark and go to 173, 174, this will start to go down, but you're still profitable. How would you lose money? Well, if the stock started to go down, but even if that happened, it would move very slowly. At 166, for example, you'd only be down 41 bucks. At 165, you'd only be down the delta times 2, so 80 some odd bucks. So this would have a slow slope that way as losses. And this is what your risk graph would kind of look like in terms of a diagonal spread, with your short option being the ideal price target. And how does this trade get really good? Well, if we just the stock chart at 167 just works its way higher over the next month towards 172. You'll have the double benefit. You'll have the benefit from the short option expiring, and you made the premium you collected on it, $100. Your long option that you paid $8.50 for, right? You paid $8.50 for this, you collected $1 for that, making a $7.50 debit. This option that you paid $8.50 for has now gone up by, 100 and some odd dollars or whatnot. So you've had the double benefit. This has had a capital appreciation, and this has made you a max profit of the credit received. And that's the double benefit of a diagonal. If you overshoot the mark, that's a little bit of a negative, but you'll still be profitable. It just won't be as good. And that's why I kind of measured out. I took the at the money straddle because this line right here is the one standard deviation. If we look at where this stock's likely to be, there's a very good chance that it's going to be inside of that general area, right? That's how it priced out. And so I'm targeting the bullish side of the one standard deviation of the expected move. So that's building a strategy based on technicals, based on probabilities, based on getting the benefit of both sides of this. And if it's not working, of course, we'll have to reassess, adjust. If that chart pattern completely breaks down, well, we're going to bail out of this and it's going to be a losing trade, right? But if it's working, this is a trade that could certainly work into December timeframe and generate not only the income, but the upside appreciation in that long option. Now, good question that might come up. Are we disregarding the gamma estimates? Because this would be better than kind of what we've calculated, in that it starts at a 41 net delta, but what do we know? As the stock goes higher, the deltas increase. The reason I'm disregarding that a little bit is because we're also not accounting for some theta loss in this option, okay? So I'm calling them a wash. I'm not calculating the gamma increase in this on the delta of our long option, because I'm also not counting its theta in this calculation. I am counting the theta here. I'm assuming this one expires worthless to a certain extent. Would we be up a little more than our calculation? Probably. This gamma should be better than the theta, deterioration of this one, but they're a little bit of an offset. So I think that the exercise is fine to do without it, and it's going to be a pretty good projection. Is it exact? No, and you can use software, by the way, and you should use software to calculate these, Thinkorswim and so forth. So let's come over now and let's do the same trade, but using the actual risk graph. Okay, I'm just going to go, it doesn't matter what you click on. Let's just buy a diagonal. I'll change everything when it pops up. Take it down to a simple one contract. Buy December 17th. Sell September 17th. Perfect. Buy 162. Sell 172 as our target. Debit, see, 750, right? In fact, it says you can get even better, 749, but let's put it at 750 because this one cost $8.50. That one paid us $1. Right click, analyze the trade. Now, it's going to look crazy because I've got other stuff selected here. Let's deselect all this other stuff. Let me delete it off. I don't know what it is or where it came from, but let's get rid of it. Okay, and there you go. There's your risk graph. Does it look pretty dang similar? Yeah, actually, it does in terms of this trade. Now, I need to bring this. Let's come back to September. Let's not see where it is in November, kind of into September. And if we look at this, here's where the stock is, pretty darn close to our break even. Where's your peak? 172. Where do you start to lose? Okay, as it overshoots to the upside. Where do you start to, or pardon me, you start to make less, I should say. You're still profitable, but you start to make less than max profit is how I should word that. Where do you start to lose? If it goes down, right? And that's your risk number. Now this does show, like I said, I was conservative, very conservative on the estimates because I probably didn't look at this one closely, and I'll bet you that gamma number is pretty big in that December 162, which would kind of make sense in terms of the further it gets in the money, the more money you make, yet that short-term option's still expiring. So it goes from making 65 cents on the dollar, probably jumps to 70s and 80s. So, this has you at a $400 profit at max gain. But it's kind of in that same realm of you can see your profit, you can see your losses, you can see where it peaks, you can see all these numbers, So I think, in terms of looking at the trade, I would certainly build it using the software, but you can also write these out manually just to kind of understand the concepts. And if we look back at this, so you can see a couple of important points here. Let's go to the theta numbers. Here's part of the advantage to this trade. What's the theta on the 172 calls? 4 cents a day. And that's going to intensify. But right now, it's eroding or making you 4 cents of decay per day. If we go to our December option, how much is that making per day? Well, or losing per day, I should say. It's at 2 cents. So just on theta, you've got about 2 cents of positive theta per day. The delta gamma, the gamma is not huge here. So, 45 delta minus our September, let's make sure we had the deltas right. 172 calls. So we had 65 minus 24, so that is 41, right? So the net delta was 41, and this also has a gamma of 4. That's interesting. So 167, if it makes that move up to 172, I mean, that's a 5-point jump times 41 delta, that's 205. They're also taking into account, I guess, actually, I made a mistake on my calculation in that it's 205 plus the $1 premium, because you got to take the net delta, but then you also have to account for the theta decay. So the way we should have written this is you'll make 41 delta times the 5-point move, plus you'll still make the $1 premium in the short option. So you'll make the $200 here plus the 100. 300 is a pretty good max reward calculation, plus a little bit of extra for the gamma. So, again, they're estimates, but I think you'd probably be up, a good target is maybe you could be up about $300, 350-ish bucks maybe if this trade worked really, really well. And if it doesn't work well, again, it's going to be a couple $100 loss or something to that effect. If the stock were to turn really, really ugly, well, of course, that's where, this trade would become a big problem. if we go back to the analyze, if this stock tanks from 167, let's just put a guess. Let's say it comes all the way down here to this lower shaded area. We're down, 400-ish bucks. That's kind of where it says you could be up about 400, you could be down about 400, depending on which way this goes. So, yeah, and the Vega numbers can certainly have an influence. Vega is more important to the longer term options. Remember, you're getting that short option eroding away. So you kind of have to assume, you could even, best case scenario, you can kind of look at it as I get all of this delta that it moves up. And then hopefully this one still expires away. So you could even say, well, the stock went up 5 points times the 65 delta, and this one went away on me. Because that's essentially what happens is if this one still expires, you didn't have any negative delta work against you as long as it goes away. If we overshoot the mark, well, then you're getting the delta here, but you're getting a negative delta there that's offsetting it. And that's why your gains start to diminish on too much upside. So kind of fun to play around with those numbers and certainly worth exploring a little bit further. So that's kind of a full analysis of an entire trade. We wouldn't have to worry about earnings or anything that way because we're trading GLD. If we were trading a stock that had earnings, we would prefer to trade this in the months before earnings and maybe even exit just prior to the earnings announcement. That would be the best way to play the Vega. So imagine a stock was going to report earnings in 2 months. You built a trade, you owned it for 2 months' time, and then just pre-earnings, just before they're going to be reported, that's when this trade is finished and you're out of it. Because as we've talked about before, volatility, implied volatility tends to ramp up as you're approaching the earnings announcement because that's when people get nervous and that's when they go start buying options and that's when they buy their protection and so on. So it's a great time to be exiting your trade. Sell into those big, fat, juicy premiums and sell essentially your options back when people are willing to pay top dollar. So fun stuff. Hope you enjoyed this trading lab today. Have a great rest of your day, and we will see you next time. Goodbye, everyone.